Ladies and gentlemen, please welcome Alessio Rastani.
Because markets are ruled right now by fear. Investors and the big money, the smart money, I'm talking about the big funds, the hedge funds, the institutions, they don't buy this rescue plan. They basically, they know the market is toast. They know the stock market is finished. The euro, as far as they're concerned, they don't really care. They're moving their money away to safer assets, like treasury bonds, 30-year bonds, and the US dollar. So it's not going to work.
We keep hearing that whatever the politicians are suggesting, and admittedly it's all been rather woolly so far, isn't right. Can you pin down exactly what would keep investors happy, make them feel more confident?
That's a tough one. Personally, it doesn't matter. See, I'm a trader. I don't really care about that kind of stuff. I go with what if I see an opportunity to make money, I go with that. So for most traders, it's not about we don't really care that much how they're going to fix the economy, how they're going to fix the whole situation. Our job is to make money from it. And personally, I've been dreaming of this moment for 3 years. I have a confession, which is I go to bed every night. I dream of another recession. I dream of another moment like this. Why? Because people don't seem to maybe remember, but the 30s depression, the depression in the 30s, wasn't just about a market crash. There were some people who were prepared to make money from that crash. And I think anybody can do that. It isn't just for some people in the elite. Anybody can actually make money. It's an opportunity. When the market crashes, when the euro and the big stock markets crash, if you know what to do, if you have the right plan to set up, you can make a lot of money from this. For example, hedging strategies is one. Then investing in bonds, treasury bonds, that sort of stuff.
If you could see the people around me, jaws have collectively dropped at what you've just said. I mean, we appreciate your candour, however, it doesn't help the rest of us, does it, or the rest of the Eurozone?
I would say this, listen, I would say this to everybody who's watching this. This economic crisis is like a cancer. If you just wait and wait thinking this is going to go away, just like a cancer, it's going to grow and it's going to be too late. What I would say to everybody is get prepared. This is not a time right now to wishful thinking the government is going to sort things out. The governments don't rule the world. Goldman Sachs rules the world. Goldman Sachs does not care about this rescue package, neither does the big funds. So actually, what I would actually tell people, I want to help people. People can make money from this. It isn't just traders. What they need to do is learn about how to make money from a downward market. The first thing people should do is protect their assets, protect what they have. Because in less than 12 months, my prediction is that savings of millions of people is going to vanish. And this is just the beginning. So I would say be prepared and act now. The biggest risk people can take right now is not acting.
Alessio Rastani, thank you very much for talking to us.
Great. Well, what I'm going to do today, I'm going to teach you something really important, and you're all going to learn something. How does that sound? Good? All right. I'm going to ask you a huge favor, though, which is before I start, could you all do me a big favor and just stand up? Is that okay? Stand up, all right. Sorry. Okay. Now raise your hands above your head like this. Okay, good. Hold it there. Now turn to the person right next to you, like this. Turn the same way. Turn to the left. All right. Now bring down your hands. Bring down your arms. Get those shoulders. Really get those a massage. Come on, get those shoulders. Knead them good. Don't hurt them now. Don't hurt them. All right. Give him a bit of a chop. Give a bit of chop. Come on. Give the chop right there. Right there. Good, good, good. Now give the bum a slap. All right. All right. Thanks. All right. Sit down. Thank you very much. Thank you. No, I just gets the blood flowing, you know, so we can concentrate here. Okay, good. Right. Yeah, as you probably noticed, I went through some changes in my hairstyle over the years. It's not as pointy anymore as it used to be. I don't know, some idiot told me a long time ago, it's like 2 years ago, hey, you should go for this boy band look. You know, JLS is doing it nowadays, so I went for this silly faux hawk or mohawk haircut. So I got rid of it in the end. So anyway, what I want to talk about today is a little bit about just quickly discuss a little bit about my background and everything. And then what I also wanted to do really is take this opportunity and kind of explain to folks what I really meant when I said I was dreaming of another recession, because a lot of folks thought, that I was dreaming of people losing their jobs and pension. That's not true at all. In fact, I explained later that my own parents went through some real hardship back in the 90s recession. Who remembers the 90s recession? Anyone? Yeah. So I definitely wouldn't want people to go through that kind of pain, but I still do believe that a recession is an opportunity. You're going to realize why. I'm going to show you, in fact, let's just go through it and I'll discuss more about that. So really, just where I started, what you see here, by the way, anyone here is Welsh? Where's my Welsh folks here? Okay. Does anyone recognize what that is? That's the University of Wales Dental School. Okay, that's where I spent 2 of my nightmare years. My parents, by the way they're raised is their children have to be either doctors or lawyers, basically I didn't get into medical school. I didn't get into medical school. I didn't get the exams, all right? So eventually I thought, you know what? Let's go to dental school. Big mistake because I hated it. I couldn't stand putting my mouth. I don't even like working with my hands anyway. I suck at that kind of stuff. So I put 2 years through it. I quit. So I sold my soul to the devil in the end and went into law. By the way, I did this presentation in Ohio about a couple of years ago, and I put up there, went to law to be a solicitor, which of course in this country means a lawyer, but in the States, it means you're a young woman with shorts about this high, standing by the side of the street. That's a different meaning over there. Anyway, but to tell the truth, folks, that I hated law as well. I just hated the whole thing. Even though I enjoyed law school, it was a lot of fun, I never liked the idea of working for somebody else on somebody else's paycheck. Many of my friends who actually went into law and worked for law firms actually realized it was a big mistake too. Many of them got redundant in the 2008 recession. They wrote me about it, in fact. I felt really sorry for those folks. So what I really wanted to do was find a way where I could basically be independent of a paycheck. In other words, find a way which is really, I don't have to be dependent on somebody else paying me a salary, and also kind of recession-proof my life in a way. So it didn't start out great. In the year 2000, anyone know what happened in the year 2000, what this is? .com crash, right. So I thought, hey, yeah, these stocks are doing really well. Let's go and buy some stocks back in the .com. But of course, as Greg Smith said, I was a muppet, just like most other muppets. So I lost huge as a result. And when the .com bubble burst, that was a huge learning lesson for me. Fortunately, I was quite lucky because I had some good friends who were traders. I did make the money back that I lost. So what I actually did was I started learning, becoming an apprentice, essentially, under some fantastic traders. One of them is a guy who turned something like $14,000 into $137,000 in about, I think it was like 3-4 months. I actually watched him do it. Sat next to him and see what he did. So I was quite lucky I had friends like this. And I started copying what these guys do, and I learned a lot from how they think, how they act, which I'll share with you, by the way, today. How did that sound, by the way? Good? Yes. Okay, good. So I quit my 9-to-5 job in law and started trading full-time in 2005. Funny thing is, in September, Daily Mail wrote some article saying, Alessio doesn't have a plush office in Canary Wharf. Well, I never wanted a plush office in Canary Wharf. As far as I'm concerned, those guys are just on somebody else's payroll, and one day they're going to find themselves on the street when those banks eventually collapse. And some of them already have. So I thought, you know what, I'm going to trade for myself, my own account, not cause pain or misery to anybody else, but just kind of support my own lifestyle from this. Yeah, so that was basically the video you saw there in September. And what happened was that about a couple of days afterwards, somebody I respected in my life a lot. Sir David Frost is. He called me up and said, hey, Alessio, you want to come on Al Jazeera and just basically tell us why you said what you said on the BBC? Could you explain yourself? So that basically was what I wanted to talk about here today. So show you folks exactly what I meant. So why a recession can be an opportunity. But first I want to share this with you. This is really important. If there's anything, guys, I want to leave you with today, it's just this. That's probably the smartest thing anyone has ever said that I stick in my mind for probably all of my life, which is this. There are two types of information. There's information for the masses, and there's information for who? Classes. Now, what do I mean by this? What do you mean by the masses, by the classes? Well, by information for the masses, we're talking about, I know it's an ugly word. I don't like this word personally myself, the herd, because it does kind of smack of genocide and things like that, I understand. But the fact is, it's true. Psychologists themselves have done studies to show that human beings, as we do act, we have this herd mentality, which is not always good. So what is information for the masses? Most of the information we get essentially from news channels. So from TV, newspapers, magazines, yeah. So just out of curiosity, how much time do you think professional traders spend in front of CNBC and Bloomberg? None. They will laugh at you. Honestly, if you say, do you watch CNBC? No, they don't. I'm not saying that CNBC and Bloomberg give out false information. That's not what I'm saying. I'm just saying it's useless to you. If you want to trade or if you want to invest, I wouldn't even go near them. By the time that stuff gets on CNBC and Bloomberg, it's too late. It's irrelevant news. You might as well just ditch it. So again, this is information for the masses. So if you really want to know what's going on, so by the way, so here's some typical stuff. This is disinformation by the media. You can only make money in a good economy. A recession is something to be feared. Oh, it's scary. And only institutional traders can make money from a crash, as you heard Martin Cruxell say in that video that essentially what she was trying to say was, well, it's only good for you, but what about everybody else? But the fact is, I'm going to show you these are all false information. Here are the facts. You can make more money in a bad economy. Informed investors all know, informed traders all know that a bad economy is an opportunity for everybody. And okay, it's true that only traders do this, but the fact is that actually is a time to making more money in a bad economy. Whoops. And yes, an opportunity, and anyone can do this. It isn't just traders in the city. It isn't just institutional traders. Anyone and you, that's basically what I'm talking about. The thing is, folks, and this is the truth. Once you understand that money can be made in any direction, whether the shares or stock markets go up or down, so once you understand actually you can make more money in a downward market, a market crash no longer feels like a threat, okay? And that's really hard for folks to understand. I understand that. Maybe some of you understand who are not familiar with this. It's difficult to understand why a market crash can be a good thing. But there is a phrase in Wall Street I want to share with you, which is markets will take the staircase upwards, but they will ride the elevator downwards. So if you know how to exploit being in that elevator, okay, then you can see why it's an opportunity and why it no longer a crash no longer feels like a threat. It actually feels like a great thing. And yes, it's true. I still stand here today in front of you to say that I really have always dreamed of another market crash. The 2008 recession was a really good opportunity, in my opinion, and I actually made some mistakes in the sense that I was listening too much to the news, which is a big mistake now. I learned that lesson. The news was saying, oh, the markets will recover. And one thing I will share with you today, one of the lessons I learned is forget that stuff. The only thing we will listen to is not the news, not information for the masses, but information for the classes, the markets. The markets will tell you everything there is to know, not the news. None of that stuff matters. So I really have been kind of counting my time to see when a market crash will occur, to use that time to essentially profit from that. So what is information for the classes? Which by classes, I'm talking about insiders. Okay. Back in the 1980s, there wasn't a heck of a lot of technology as it exists today. All right? So back in those days, in the 80s, when traders would make decisions, yeah, a lot of the people wouldn't be able to see what they're doing. Okay? But nowadays, it's almost impossible. Because the technology has moved on so fast, when the big money, the smart money, so we're talking about, of course, Goldman Sachs and JP Morgan, all these big guys out there, when the insiders are doing things behind the scenes, they leave trails behind. Okay, they leave footprints, just like when a burglar gets into maybe your house. I hope that's never happened to you, but they tend to leave traces behind. Our job as good traders, which I hope certainly most of you will become, our job is to find out what those first of all, what are those footprints, and then follow them. Okay, so really what we're doing is kind of catching the coattails of the big money and see where they're going. All right? Does that kind of make sense, by the way, to everybody here? Yeah, if you're with me, say aye. Aye. Okay. So what we're looking for is price patterns, signals. Oops. I think that's a laser. Yeah, price patterns, signals. So we follow the footprints, following the charts. What are charts, by the way? I'm going to show you what I'm talking about. So charts are visual representations of the markets. I'm a firm believer in the Dow theory. It is controversial. Not everybody agrees on this. But I am a firm believer in the Dow theory, which I'll explain to you what that is. The Dow theory states that the markets reveal all available information. Everything. Write this down if you have a pen and paper. Everything there is to know is reflected in the markets through price. In other words, the charts represent the sum of all the fears, hopes, and expectations of investors. Everything about earnings expectations, interest rate expectations, product launches, and are priced into the markets. Now, I will say this is not agreed with everybody. But I will say to you that the majority of professional traders that I know will stick by this as fact and truth. So often when folks come up to me and say, oh, well, this stock has been just being given a boost by some analyst, or Bloomberg said, oh, this stock is a fantastic buy right now. You should go and buy this stock. Or so-so said this, give me a tip on this. Or maybe this PE ratio of this stock is fantastic. I don't care about any of that stuff. Honestly, I don't. The only thing that matters is whether the markets tell you that that is the case. So, this is what I'm saying is, it doesn't matter whether some big shot analyst out there, or the barons or somebody is saying, hey, they've upgraded the stock. The first thing we should always do, which I hope we will all do, is check if the markets are saying, if the markets agree. So one important lesson I've learned now is, in fact, write this down if you can. Lose your opinion, not your money. That's number one. And number two, lose your ego. Well, let's put it this way. Don't listen to your ego, but listen to the markets. Does that kind of make sense? All right. What I mean by listen to your ego, one of the things I learned from George Soros, I happened to listen to one of the interviews that he was doing. George Soros said that he never has an attachment to any of his trades, any stock he's ever done. He doesn't hold an attachment to them. Whereas you see most folks don't do that. I'm sure you know people who've told you how they will stick to a position, they will stick to a stock, even though they know it's going against them. We've all done this. Who has done that before, by the way? Who's ever done that? Yeah, I've done it too in the past. Yeah. Just out of curiosity, who's in the markets right now? Who's in the markets? Put your hands up. Okay. And who here has done some kind of leveraged trading, whether it's options, futures, or spread trading? Okay. And who is not going to raise their hands no matter what I ask? Okay. All right. So what am I talking about? Why do the markets reveal? Now, have a look at this. This is the crash of 2000. Oops, shouldn't go there. This is the crash of 2008. You can see this market. This is the S&P. This is the S&P 500. The market just crashed here from 2000, from 1500 all the way down to 700 here, 700, just below 700. So yeah, that was a pretty rough time for most people. I understand that. There's a buy signal here. I'm going to explain to you later why that was a buy signal. Okay, we're all going to learn this. Okay, I'll explain to you exactly why that was a buy signal right there at the bottom. And the market, of course, rallied from 2000 to 2011. Now, here's something very important. You see, folks, as I'm sure most of you remember, in 2009, 2010, 11, if you listen to the radio, put on the TV, everything is always negative. markets are gloomy, economy is bad, and everything like that. The fact is, despite the fact that we're still pretty much in a recession, pretty much everybody was saying, hey, how things are tough, the fact is markets rallied. Okay, so there is a disconnect. This is very important. There's a disconnect between how we feel what the economy is doing, and what the market actually itself is doing. So anybody who was listening to the radio or TV and the kind of stuff about how the economy is in bad shape would have missed out on this opportunity to actually make money here on the way up. And yes, they would have missed an opportunity to make money on the way down. And I'll show you that today as well. This is where we are right now. Now have a look at this. I want you to just spend a couple of seconds having a look at that. That is the stock market right now as we speak. That is how we closed on Friday. Oh, by the way, I know that some of you, I'll explain this to you in a second, but some of you who are not familiar with charts, just to be clear, the blue bars show to you, this is a daily chart, the S&P. The blue bars essentially show the markets are going up, okay? The red bars mean the market's going down, right, exactly. So when you see reds, that's negative down days in the markets, whereas the blue ones are up days, okay? Now have a look at this. This is something very interesting here. What I've written here is, are the markets pricing in the European crisis possible outcome? Now, we know that on June 17th, there's a major vote coming out in Greece. We may find out very soon whether Greece will or will not leave the euro. There's a lot of, the media seems to be persuaded now that pretty much we could expect the Greece could leave the euro. But here's something very interesting. I recently heard one of the major banks, I've not mentioned their name, but one of the major banks came out and said that if Greece does leave the euro, stock markets will crash by 50% when that happens. Now, I can tell you this right now, that is a lie. That is not true. In fact, I'll tell you what's going to happen. If Greece does leave the euro, what will happen very soon immediately is the central banks will get together and they do the same thing they did back in November 2011 and back in May 2010, which is what? Right, quantitative easing, QE, or printing money. What they'll do is start pouring liquidity into the markets, and markets will rise. So this is contrary to what most people think. Most people think, no, wait a second, markets will crash. But you see, this is what's happening right now. Does anybody here seriously think that the big money, the Goldman Sachs, JP Morgans of the world, do you think they're just going to wait to see what's going to happen to Greece? You think that billions of dollars that are out there right now, let's just leave it to chance. Let's see what happens, whether Greece will leave. No. See, the markets are already pricing in. The big money is already pricing in what may happen. They're not taking chances with those billions of dollars. So that's why you see the markets tanking. And by the way, Friday's close, as you'll find out from this week, was significant. Because, again, I don't want to go too technical on you folks, but we closed below 1280, which was a major support level. Something I'll tell you about more in this seminar, talk seminar. But anyway, we closed below 1280. Things, as you'll see, this week are going to be huge. It's going to get pretty ugly from this week onwards, because we were hoping that the markets would close. They wouldn't take out these lows and close up here, but actually did not. The fact that it closed below 1280 is significant. And it tells us there's huge fear. There's fear in the markets. So what I'm saying here, folks, is this. By the time we've moved to the position where Greece may leave the euro, or even Spain may leave the euro, it's going to be too late. Now is the window of opportunity to make money from a crash. Or certainly, I would not be buying stocks right now at all. I know there's some folks out there saying, hey, buy into stocks. No, not yet. I think this is going to get pretty ugly from here, and we may see some more downturn. But when Greece does leave the euro, I'll guarantee you, immediately, the central banks will do the same thing they've always done and start printing, start pouring liquidity, again, as we've been saying, more debt upon debt upon debt, which will just implode upon itself eventually down the line. That's the euro, as you can see here, Euro 2012 as well. That's tanking, that's crashing here as well. Okay, so I want to, first of all, teach you something very important. We all know about the boom and bust cycle, the economic cycle. Economists don't call this boom and bust. They call it expansion and contraction. Now, here's something that you don't always hear. But this is the fact. There aren't just two stages of the economic cycle. There are, in fact, 5. Let's go through them. The first three are called early expansion, middle expansion, late expansion. Then we go through early and late contraction. So folks, how many stages are in the economic cycle? Let me hear you. Five, good. Now remember that. Why is that important to know? Because certain sectors do better at different phases of the economic cycle. See, a lot of folks think, oh, well, this stock is doing very well right now. Let's go buy that. No, that's not the case. The way you should really be thinking is which stocks do well at which phase of the economic cycle. So obviously, certain stocks will not do well, for example, in stage. Let's have a look at this. In fact, research and studies have shown that technology shares do very well at stage number 1, which is early expansion, the beginning of a boom. But in stage number 4, utility companies, healthcare companies, consumer staples can do very well at stage number 4. Have a look at this, by the way. By the way, if you want a copy of this, I know some folks saying, well, where can we get all this stuff? What I'll do is, folks, I'll give you a link you can write down, and I'll have this all uploaded for you on a video or on a slideshow so you can download. Would you like that? Yeah. All right, so what I'll do is remind me at the end of the program. I'll definitely have this ready for you. I'll make a video for you this week, and you can go and download all this. That's the website, by the way, as well, leadingtrader.com. Okay, so this is the economic cycle, business cycle. Now, here's the same thing. You see early bull, middle bull, late bull. So it's a bullish period. The markets are going up. And then we go into a bear market. So early bear, middle, and I don't really consider late bear, middle bear to be important. We focus on early and late bear because this tends to be quite fast, much faster than the first three phases. Now, as you will see from this image, from this particular picture, something you'll see is the kind of industries that do better or do well are located for you on these different parts of the economic cycle. Now, let's just focus on the recession stage, which would be, so we're talking about early bear, this area here, the beginning of a recession. And it says over here, 3 and 1 do very well in early recession or early contraction or early bear. 3 and 1, let's have a look at that. That is healthcare and consumer non-cyclicals, also known as consumer staples. Now, I'll show you what that means in a second for some folks who may not know what consumer staples are. Oh, and what else? Yes, also utilities. Utilities do very well in a recession here as well. Now, let's just talk about this for a second. So we're talking about utilities. Let's understand this. In a recession, folks, you tell me, do you think people will still need things like water, electricity, and gas? Yeah, absolutely. So why not? These things still do well in a recession. And what else does well in a consumer staples? What are we talking about? Tobacco, alcoholic beverages, hospital management. People say, well, why is this? Well, there's an economic theory that in a recession, people, of course, get worried. They get stressed. Stress levels go high. When people are stressed, what do? Well, they smoke more. They drink more. Eventually end up where? Right. Let's have a look at this. Let's see if this is true. This is the technology crash of 2000, economic downturn in the beginning of the decade. Well, the century. So you can see the stock market's crashed. This is the XLU, which is the ETF, the utilities ETF, exchange traded funds. Okay, so this is actually something you could invest in. So the ETF of utilities did the exact opposite of the stock market. Market goes down, utilities goes up. Write this down, folks. This is a website I recommend you should. Okay, this will take you to this particular page you see here. It's a market map. Leadingtrader.com/market map. Okay, let me repeat that. Leadingtrader.com/market map. Then you'll get this page. What this is a market map. Now, what is a market map? It's a map of the market. Okay, all it does, it puts the entire stock market into blocks. So what have you got? We have the materials industry here. We've got industrial industry block here. We've got healthcare. We've got financials, utilities, energy, and blah, blah, blah. They're all there. By the way, you'll see the squares inside these industries, this block. These are the individual companies, the main companies inside these sectors. Now, why are they red and why they're green? Okay, here's the clue. Write this down. The brightest green shows to you companies doing the best. Brightest red shows to you companies doing the worst. Okay? So if you were to be investing in a particular industry, you would want to see more of which color, green or red? Green, absolutely, right. So you want to see more green, see which ones are doing. Have a look at this, guys. First of all, but automatically we can see the ones which are very red. Can we not? Yeah, by the way, very important, write this down. You've got to change this. By default, when you go to this page, it'll say 1 day. No. You don't want the 1 day. You want to see a 1 month trend. You want to see what's been happening in the last month. And this, by the way, guys, is a great way to find out where the money's going. Okay, where is the money flowing into? So 1 month % change. You want to see what's been happening the last month. So who can tell me? Well, first of all, the ones we're going to avoid here are financials, obviously. Financials have not been doing very well. Goldman Sachs, tanking. Bank of America's tanking. But anyone can tell me what is interesting here. Which ones are more green or less red, put it that way? Cigarettes. Was that right?
Cigarettes.
Yes, well done. So you got consumer staples, well done. So again, tobacco, things like that. What else is not so very red or more greenish? Well, I would say this one, right? Utilities. You don't see a lot of reds here at all. See, these are very red, so avoid those. But you see definitely consumer staples and utilities, exactly what we'd expect. So again, by the way, this is something important to understand, is that in times of crisis, when markets are getting jittery, you do see a flush of money out of financials, all these other industries, and into the safer industries, the utilities and consumer staples. Again, it's a big clue to what's really going on behind the scenes, what the big money is doing. Is this useful, yes or no? Yeah, good, okay. So look, folks, over here, this is the S&P. This is right now as we're speaking. The S&P, the stock market, has been going down, as you can see here, since the beginning of April. And yet you can see utilities are on the way up. All right. So again, what I'm trying to say here, folks, is usually in market downturns, this is what you see, where utilities and certain particular industries do very well and other things don't. What about the euro then? Let's have a look at this. Now, I'm going to show you a fantastic way to actually hedge against a falling euro. Because a lot of folks always complain, oh, the euro's falling and all that, the value of my pension is destroyed. Well, there is a way you can hedge against that. And the way you do that is, okay, this is an ETF. This is a particular index, when you call it that. And what it does is it tracks the price of the euro, and it does the inverse. It's the inverse to the euro, as you can see here. It's going down, that goes up. Euro goes down, this goes up. So have a look. This is actually right now as we're speaking. This is the euro dollar. This is the euro, as you can see, tanking over here from 1.32, right now 1.2426. And as you can see here, the EUO, but that's a symbol you got to remember, EUO, that's the ETF, is going up. I will say this, folks, it's very important that please do make sure that if you are doing anything like this, do protect yourself against risk. Definitely use a stop loss, and we'll talk about that in a second. But whatever investment you do, whether you're hedging or not, make sure that you use protection. In other words, you use stop losses. So if the markets don't go in your direction, if you make a wrong call on something, then at least you don't lose a lot of money. Because certainly this stuff is risky. Anything to do with investing, whether it's hedging as well, is going to be risky. But nonetheless, if you hold euros, if you hold money in euros, then if you're worried about a crash like this, then yes, you can hedge against that by using the EUO. So at least it works out 2 ways. Okay, this is the candlestick chart. This is the charts that I'm talking about here, folks, by the way. So just remember this, folks, that when you see the charts that I'm going to show you, the ones that are blue means up days or upward bars, upward markets, and the ones that are red are down bars. Okay, the markets go down on those days. The one thing that's important to understand is this, though. Just remember this. When you see these spikes, these are the highs of the day, and these are the lows of the day. As you know, as the markets, as they tend to go up and down on a particular day, they make highs and they make lows. Okay? So whenever you see these bars like this, that was the high of that day, the price of the highs. That was the price of the lows. And very important, just remember this. This is the body. It's called the body of the candle. That's the close. That's where the market closes. On blue bars, that's where the market closes. On red bars, that's where the market closes. Okay? So on blue bars, closes up there, when that closes up there, and the red bars closes down there. Now, why is that important? I'll show you why in a second. Okay, so how do we make money from a falling market? Selling short. Who's ever heard of selling short before? I'm sure it's, yeah. But I understand that most folks probably may not be familiar with exactly how it works. Okay. So let's just do a very quick and easy, actually, before we do that, it's very important to just understand the law of opposites. What is the law of opposites? Very simple. Law of opposites simply says if you buy to enter a market, this is the way that most people usually do it. Obviously, you buy low, you sell high. So if you're buying into a market, if you're buying stocks, then you have to do what to exit? Sell. Yeah, it's simple, makes sense. You buy low, you sell high. That makes sense. All right. But what I'm talking about here is something the exact opposite. So what you do here is you sell high, but you buy low. All right? So you sell to enter, but you buy back to exit. That makes a little bit, I understand it sounds confusing to a lot of folks, but I'm going to show you it actually makes perfect sense in a second. So just remember this. For selling short, you sell to enter, but you buy back to exit. And I know some of you are probably thinking, well, how do you sell something you don't even own? Aha. Right. Here's a perfect example. I'm going to show you this perfect example. This is probably the best and easiest way that I learned how to sell short when I first started trading many years ago. But actually, this makes perfect sense. Imagine this. Let's say let's just say your best friend. Your best friend calls you up one day and says to you, hey, you know what, I'm going to the Bahamas for a few months, about 6 months. Can you look after my brand new Mercedes for me for 6 months? What do you say? Hey, why not? Yeah, okay, sure, I'll do it. So he lends you his car for that 6-month period. Here's what you're going to do next. You're going to sell his car for whatever it goes for. Let's just say $100,000. Keep it simple. Okay. I know it's not morally correct, but let's just go along with this. You're going to sell his car for $100,000 without his knowledge. And you will keep that money safely in the bank. You keep the $100,000 safely in the bank. You don't touch it. 6 months later, your friend comes back. He says, hey, I'm coming back tomorrow. Okay? You got my car ready? Yeah, why not? Sure. Okay. So what you're going to do next is quickly go back to the guy you sold it to, find him, okay, and then buy it back. Now, wait a second here. This is where it gets interesting because how long has passed since your friend gave it to you? Remember, it's a brand new car. It was a brand new car when he gave it to you. 6 months, right. $100,000 when you sold it. Is it still worth $100,000? No, of course not. It's now probably, let's say it was $85,000. Let's say it's depreciated by at least $15,000. So you will buy it back, not for $100,000, but for, buy back from original buyer. You buy, yes, it's depreciated in value. As we know, it's a depreciating asset. You buy it back for $85,000. You return the car to your friend. Here you go, buddy. Your car's back. He's happy. But you're happy too, right? Why? Yeah, you just keep the difference. You bought it for $85,000. You keep whatever this difference is, about $15,000 from a car you did not even know. Now, how does that work with shares then? Well, most folks don't know this, but in fact, this is what you can do. Your broker lends you the stock of a particular company. In fact, this actually comes from the broker's own inventory, and they can do this. Okay? Broker will ask you for a deposit to cover the value of the stocks. Okay, so this is similar to, for example, your friend saying to you, hey, look, I'm going to lend you my car, but I'm going to need some deposit from you just in case. So that would mean like you giving it to your friend if you had the money, like £100,000. But anyway, let's go along with this. So broker will ask for a deposit to cover the value of the stocks that you're basically borrowing. I'll give you an example of this in a second, don't worry, folks. As a collateral. What you will do is exactly what you did with the Mercedes. Sell the stock at the market, at the highs, the higher price. And when the stock eventually crashes, you buy it back. Just like when the Mercedes depreciated in value, you bought it back. And you give the stock back to your broker. Well, your broker's happy you got his stock back. And you pocket the difference. Let's have a look at this. This is an example on Ford Motor when it crashed in 2008. Now, one of my better trades actually was the one I did, I remember back in 2010 when BP shares were in trouble. Remember that? The whole BP crisis, yeah. So this is a horrible thing, by the way, as well, because I don't like talking about this because it's a terrible thing to mention, but in the 9/11 attacks, again, I can't confirm this, but maybe some of you will confirm it is true, but I heard from a respected radio host in America that one of the traders in the very tower when it got hit, he went and he did what I'm just showing you. He shorted airline stocks. He died in the tower, but he made $1 million. All right? So yeah, I mean, this stuff really happens. So here's what happens. So Ford Motor, let's say you speculate that Ford Motor is in trouble. Ford Motor is going to fall in value. So what you do here is, let's have a look. You go to your broker, you ask your broker to borrow 100 shares of Ford, your 1,000 shares of Ford. Of course, your broker will ask from you a deposit to cover the value of the stock. In this case, we're talking about a stock is valued $8, okay? So he's going to. So if you're borrowing 1,000 shares, it's 1,000 multiplied by 8. So you're borrowing 8,000. So he'll want from you $8,000 from you. And what you will do next is, when he gives you the shares, you will sell the Ford shares at the market, okay, $8 per share. Does that make sense to you so far, by the way? Yeah. All right. Sell them at $8 multiplied by 1,000. So you get the $8,000. Okay. That will actually be kept. That will actually be kept. What happens is your account will be frozen until you exit the trade. Ford stock then price drops in value. Okay, let's see, it fell from $8 to $2. So what are you going to do next? Right, buy it back. Remember, folks, the exact opposite of what we would normally do. We're not buying low, selling high. No, we're selling high, buying low. Does that make sense, all right? So buying back at Ford shares at a discount of £2 per share, $2,000. All right, so basically, you're buying it back at a discount, at a much cheaper price. Which means, for you, it is how much? Yeah, you return the shares back to your broker, but you just made $6,000 in 5 months from 75% return on stock you not even know. Here's Bank of America. Check this out, guys. I mean, you can see Bank of America. This is, again, what I'm talking about. This is why Wall Street says this. You know, it's a staircase on the way up, elevator on the way down. It took how long? 25 years? Is that what it is? From 1985 to 2008, from $5 a share to go to $55 a share, and then within a year, check this. That is a free fall. I mean, $55, bang, to $5. So you can see, I'm hoping I can see whether you can understand why for a lot of traders, including myself, why a market crash can be so lucrative and so attractive. Bear Stearns in 2008. Bear Stearns was 125 back just before, as of 2007. In 2008, this is March 2008, $75 a share. Within 2 weeks, it went to $4 a share. It went down to $2 a share. Probably one of the most famous crashes in history. Now, I know I get this a lot in these seminars or in these events, and people always say, oh, selling short is immoral, you can't do this, it's unethical. No, it's not true. Selling short, not only is it moral, but I'm going to prove to you and try and persuade you, hopefully, that not only is it a good thing, but we provide a service to the market for 3 reasons. Again, people who say short selling is risky and morally wrong, that's information for the masses. It's wrong information, incorrect, not true. Here's reason number 1 why selling short is not immoral. Because, number 1, here's the moral. Overcomes a tyranny of overpriced shares. Anyone remember Facebook? Yes. Did it ever deserve $42 a share for what we know is a Wall Street inflated the stock deliberately to make money and then dumped $100 billion of Facebook toilet paper onto the public. And people who, I understand, I mean, I've been making a lot of jokes about Facebook, but the truth is, and this is a true story, which I read in the Wall Street Journal, a father took money, I think the entire money, out of his daughter's college fund. I think his name was Mr. Supple, I don't remember. But he took money out of his daughter's college fund, because she loved Facebook, to buy Facebook shares. And I knew this was just going to be a Muppet bait waiting to happen. So yeah, Facebook did not deserve $42 a share, so why not drive this price down? There's no way to deserve that. Overpriced stocks, overinflated by the Wall Street market, that when they don't deserve to be that high, they need to be brought down to earth. And I'll show you, by the way, later what I expect Facebook to go to and how, in fact, all of you can actually profit from that as well, what you should be looking for. Okay. Number 2, make stocks more affordable. I mean, this is probably the best explanation for it. This is Apple. Apple, and since beginning of the new year, I mean, it's been skyrocketing here. A very amazing trend here from $400. Actually, it was $300 back then, so doubled in value to $600. When stocks just spiral and bubbling, without short sellers, they would just spiral out of control. So we need short sellers, we need folks like us to actually bring them down, not only to bring them down to earth, but to make it more affordable for folks. I've written down here is similar to a Mercedes. You don't buy a Mercedes at high prices. You wait for a sale, and then you'll buy it. And this is, in my opinion, the best reason why we need short sellers. Okay. Because without short sellers, it would be very difficult to find a floor in the market. Short sellers, actually what they do is they put a floor in the market, a bottom, so that the rest of us can join in. Let me explain to you what I mean by that. Have a look at this. So this is a stock. It doesn't really matter what it is. This could be any market, but just in case you're wondering, this is Goldcore, a gold stock. Now you can see that this stock is being shorted. Okay, it was falling in value here. And yes, there was no demand for it. It's falling here as well. But you see, here's the problem. Here's the problem here. Most ordinary buyers, okay, imagine you were thinking of buying the stock. You put yourself in this situation. Let's say you were looking at this and you were thinking of buying the stock. How would you feel about that? I mean, this is just like, the stock is just cratering. Most ordinary buyers and investors would feel a bit nervous and jittery about putting their money into a stock just falling. Right? But here's the point. Short sellers have to buy that stock. Why? They have to buy it. That's the only way they can exit. Remember, guys? The law of opposites. Normally, ordinary buyers buy to enter, sell to exit. But short sellers do the exact opposite. They sell high, they sell at the highs, and they buy. They buy to exit. They have to buy to exit the market. So basically what happens is when these short sellers exit the market, they have to buy, which pushes the price up. That puts a floor in the market, which feels good now for the rest of us. Oh, there's a floor in the market. This market will be bottoming here. And that's when the sentiment drives towards the bulls. Does that make sense, by the way? Yeah? So that's another very good reason. Short covering, short squeezes, put a floor in the market. Now, for the UK, by the way, if you don't have to short sell if you don't want to. There's much easier ways nowadays for folks to make money from a falling market called spread trading or spread betting, which is tax-free and no commissions. I've actually put a number of my recommended brokers, which you can try. Go to this one. Go to leadingtrader.com/trading tools. Write that down. People always ask me, where can I get these charts and things like that. Again, I put on that page, some free charts recommendations for you as well if you want to give it a go. So if you are looking for free charts. leadingtrader.com/trading tools.
This is your company?
Yes, it's actually my website. Sorry. I'm the founder of leadingtrader.com. Yes. Forgot to mention it. Okay. And yeah, if you, certainly, I'll tell you about it. Okay, so I'm going to show you now a simple strategy for entry and exit. So, again, number one, this is very important. Before we even talk about a strategy, this is what's, I think, wrong with the financial industry and with the trading industry, is that people are told that, to make money in the market, you need a strategy. And a lot of, I see this all the time. It's been documented that the way amateur traders and amateur investors think is very simple. They all think like this. What do I buy and when do I buy? That's the way most amateur traders out there think. When do I buy? What do I buy? That is not the way professional traders think. Professionals, in fact, think, first of all, yes, when do I buy? But when do I sell? When do I sell? Not only to make a profit, but also, what happens? What if I'm wrong? Yeah. So, as I'm sure most appreciate, trading is all about probabilities. There's no certainties. Okay? All we have is an edge. Okay? So when a trader puts on a trade, he has maybe a 60 or 70 or maybe 90% probability the trade will go in his direction. But he also knows, a professional trader knows he could be wrong. So that's why we must always ask, if we're wrong, if we made a wrong call, when must I exit? So we don't hold a position that's going against us. As I mentioned before, George Soros, famous trader, has admitted he has absolutely no attachment to any of his trades. When he knows he's made a mistake, he's actually said this himself, when he knows he made a mistake, thing is not going his way, he'll cut it loose and get out of the market. Okay? You want to basically make a small loss, but you want to let your profits run. Does that make sense, by the way? Yeah. If you're with me, say aye. All right. I want to share with you a story. One of my best friends used to work for Goldman Sachs. And I've known him. We're still talking. And we're still talking. Yeah, but here's something I want to share with you. Now, his job in Goldman Sachs was not a broker. Okay, he had a very special job in Goldman Sachs. He was a controller. And what he did, let me tell you why his job was so special. Because what he would do in Goldman Sachs, he would be able to watch the trades of every customer. He would see exactly what every ordinary retail customer was doing in their trades on his computer screens. And here's what he found out. 90%, this is the majority of the customers who were trading their own accounts, they were all making the same mistake. Every one of them, almost 90% were all making the same mistake, which was they all over-leveraging, trading too much for their account size, over-trading, putting on a lot of trades, and not protecting against risk. In fact, what they were doing is letting losses run. So you know what he did? He left Goldman Sachs. This is a Goldman Sachs in Australia. He left Goldman, he quit his job. He actually started up his own account. He did the exact opposite of what all these guys were doing, all these customers were doing. He took small trades, took small amount of risks, didn't over-leverage, took just about a right position on his stocks, about 1% to 2% of his account. And he now has $1 billion hedge fund. And I learned a lot from him, this guy. So this is the point, guys. The way amateur traders think is actually very human, but we must do our best to not get tempted to go that way. Risk management is key. Risk management. This is the way all professionals think. Professionals don't think, oh, I should win on this trade. I should make money on this trade. No. Winning, losing, making money is not important. All is about risk management. Write this down. This is actually one of the best lessons I learned from a trader in America. If you take care of the risk, write it down. If you take care of the risks, the profits will take care of themselves. All right? I'll repeat that. If you take care of the risks, the profits will take care of themselves. All right, so here's the strategy. You ready? All right, you ready to learn something really cool or not? Yeah, okay. All right. I want to show you, this is really simple, folks, but I'm going to show you, not only is this simple, this is a proven strategy to trade the markets. It still works today. Even though it's still been used for years, decades, it still works today, and it's still a very reliable and proven method to trade the markets. It's very simple. Okay? Anybody seen this movie, by the way, called, it's an Eddie Murphy movie, in fact, called Trading Places? Yeah? For those of you who haven't seen it, Eddie Murphy plays this homeless guy, and two Wall Street big shots, they see this homeless guy and think, well, I can bet you that I can turn this homeless guy into a trader, okay? And one bets against the other that he can't do it. This actually, now it's not known whether this story inspired a real true story or this other way around, but this is actually a true story. Two famous traders, names of Richard Dennis and William Eckhart, did this in the 1980s, where they put an advert in the paper saying, hey, apply to us, and we select you, you can trade our money. We'll teach you how to trade. These people became known as the Turtles. There's a good book out there. I recommend you read it. It's called, it's by Michael Covell. Write down Michael Covell. And I forget the full title. It's about the turtles. But if you go on Amazon, you'll find it. The Turtle Story. Okay? The total turtle story. But anyway, they call it turtles. Don't ask me why. I've forgotten the reason. But anyway, so what happened was the way that these guys traded the markets, and this was kept a secret for many years. They kept it a secret as to how they trade the markets, but eventually they released it. But the way these guys traded is very similar to what I'm going to show you here. Okay, so how do you buy? You wait for a close above the high of the lowest 20-period bar. I know that sounds like a gobbledygook. It doesn't make much sense, but I'll show you it does make perfect sense in a second. Okay, a close below the high of the lowest 20-period bar, and for selling short, a close below the low of the highest 20-period bar. Okay? Now, just write it down or just remember it. I'll show you exactly what that means in a second. It's not difficult at all. Okay, probably it makes sense if I show it to you and actually demonstrate it to you. It makes more sense. Have a look at this. This is LinkedIn. This is stock of LinkedIn. When it actually went on went live on the stock exchange. This is its first few weeks. I'm going to show it to you on LinkedIn shares. Anybody here on LinkedIn? Okay. I still get their annoying messages saying, hey, so-and-so wants you to join, and I just ignore them. Okay, so here's what you're going to do. You will have to basically, what you do is you count back 20 bars, all right? Count back 20 bars. Now, obviously, this is because the stock went live on the stock exchange, there's nothing in the past. So you'd have to wait at least to see how this plays out for at least 20 days or at least a few weeks. So I wouldn't be buying the stock in the initial stages anyway. But once it's had a good run, about a few weeks, count back 20 bars, okay? Identify the lowest bar. Yeah, identify the lowest bar. Sorry. And then, so this is the lowest bar of the 20 periods, okay? That is significant because what you want is when the market closes above the high of the lowest bar, that's a buy signal, all right? You see that this was the lowest bar of the 20 days, 20 periods, okay? When the market closes, see that bar here closed above this, that is your buy signal, all right? And of course, let me show you. Okay, so if I can just do this quickly. Felt tip pen. Okay, so as you can see here, this was the low bar. Oops, maybe I can use a mouse here. And when the market then came here and said, hey, I'm going to close above you here, that's a buy signal. Now, of course, what if the market went against you? What if it did this and went against you? Well, you'd have to put a stop loss at the lows here, okay? Put it at the low of the low bar. And then, as the market goes in your direction, are you following me on this, by the way, so far, guys? Yeah. As the market begins to go in your direction, as you can see, the market goes in your direction. So, question is, when do you exit, right? Okay, here's what you do. As the market begins to go in your direction, trail your stop. In other words, trail this. A stop, by the way, for folks who are beginners in this or new, a stop loss is an order you place with a broker to tell him to exit that market, exit that stock. You're telling him, look, sell my stock at that point. Okay, it's an order you place with your broker. Okay, so as the market begins to go in your direction, let's say you were on this bar. Let's say here. So the market's gone up here, and you're on this bar here. Well, here's what you do. Count back 5 bars. So let's count. 1, 2, 3, 4, 5, and put it at the lowest point of the 5 bar. Okay? 5 bar trailing stop. That is the low point right here. Does that make sense? Okay, let's do another example. What if the market continues going higher? So now you are here. Let's say you're here. Well, again, once you're on this bar here, you obviously made money here. You made a profit here on this move. So again, count back 5 bars. Let's count back 5 bars. 1, 2, 3, 4, 5. That's the 5 bar low. There it is. Identify the low. This will keep you in the trend as long as possible. All right? Let's move on from this. Let's go to the next one here. Next. Oops. Pointer options, arrow. Okay, so there it is. Exit of 5 bar trailing. So you actually exited right over there, close by the high bar. Okay. Oops, wrong one. So here it is, guys. This is the exact what I've just done here for you. This is the instructions. Count back 20 bars. This is for buying, by the way. Count back 20 bars. Identify the lowest bar. Wait for the close above the highest point of this bar. Enter at the open of the next bar. Exit at the 5 bar trailing stop. And you're probably wondering, well, what if you're selling short? What if you're making money in the downward market? Well, just turn things around. All right. Here's one example here. This is Apple. This is Apple not so long ago. Apple shares go down. Okay? Where's the low bar? Right there. You see that? Okay, I can count back 20 bars. Where's the lowest bar? There it is. Okay, do you buy it right there? No. What are you waiting for? A close. A close above what? Right, that's what you're looking for. A close the next day must close above that low bar. That's your buy signal, and you can see that actually the market continued to rally from here. And again, you exit at the 5-bar trailing stop. Okay? But actually, if you'd applied a 5-bar trailing stop, that would have kept you the entire move right through. You probably exited right about there at some point. Here, oh, there it is. This is Apple. This is just recently, by the way. This is Apple run here, rallying from here. Now, does it always work? No. Does any strategy always work every single time? No. This is obviously, most of you know this. You can't win every single time. The point is, though, these two would have made a small loss. Okay, so these two signals to sell would have made small losses. Okay, but when you do win, the point is to follow the plan so that when it goes in your favor, you are making up. Sure. Okay, so again, this is the British pound, same exactly in the British pound, as you can see here. Two signals to sell. This one would have made a small bit of money. That actually was the most recent one back in May. As you can see here, this is the high bar. It closed below the high bar. It closed below the high bar, as you can see here. That is the signal to sell short. This also avoids temptation to pick a bottom. Here's what most people do. A lot of people do. They think, oh yeah, that's a bottom here, right there. It's not going to go any lower. This is the fastest way for people to lose money. They're trying to pick bottoms in the market, and the market still goes against them. But by applying this rule, would you have bought right there? No, why not? Exactly. That was the lowest 20 bar, yes, but did the market close above the highs? No. These spikes are not closes. The closes must be, okay, the body of the candle must close above the highs. Does that make sense? All right, that's why I said make sure you remember that. And the market continued to drop. Now, here's interesting. This is Friday. This is Friday. What must happen to be a buy signal on British pound? Exactly. On Monday or this week sometime, we must see a candle or a bar that must close above the highs here. I actually calculated it must close above 1.5440. Okay, 1.5440. But by the way, when I say buy, I'm not expecting it all come all the way back up again, no. But it probably will have a small rally to 1.56. And this is Facebook. You can do the same thing on Facebook. If those of you are wondering, well, when do I buy Facebook? Just apply the same exact rule to this as well. Wait for at least another couple of weeks. Count back 20 bars. Identify the lowest bar, and a close above that will give you a buy signal. If you lose, yeah, it's only odds. It has good odds, but that's the way trading works. There's no guarantees. And as a stock market, I know it's just the last thing I'm going to mention here. This is 2009 market crash. Do you all remember that? Yeah. Now, earlier I showed you it was a buy signal on this chart. Why? Market crashed on a weekly chart, the S&Ps. That was the lowest 20-bar low. Okay, this one didn't work out so well. Had a little bit of a pop here. But this one was the lowest 20-bar low. Market closed above this bar. That was a buy signal right there. And you actually managed to catch the almost exact bottom. You would never catch the exact bottom, but the lowest part of it. So last note, guys, here's one thing I want to leave you with. When it comes to trading the markets, the doom and gloom is a good thing. Because unstable economies create volatility. The more instability, the more bad news comes out, the more volatility there is in the markets. Volatility can create trends and big moves which informed traders can crave for. And markets are more lucrative than a market crash. And finally, don't just anticipate, participate. I hope you have all good trades, guys. And I'm just going to leave this with you as well. You can contact me on Facebook.com, Twitter. That's my email. People always ask me, well, how do I contact you? There's my contact address. Or shine a beam of light in the sky, and I'll get you Batman style. Okay. All right. Thank you very much, guys. I appreciate it.
Great job. Great job.